The hardest part about planning for retirement is that the future is so uncertain. You have no idea what the stock market might do next, what will happen with inflation, how long you'll live, which makes deciding when you can retire and how much income you can draw seem like an impossible task. But there is one tool that can solve all of these problems for you. Over the last 10 years, it has fallen out of favor, but now with interest rates on the rise, I see this strategy becoming the cornerstone of many people's retirement plans. So in this video, I'm going to show you how this strategy works, why it's so effective, but also why so many people hate it. So you can decide whether this will work for you. Hello and welcome back to the channel. If you're new here, hi, my name is James. I am a financial planner, and a few weeks ago I was speaking with a gentleman called Tim who had got in touch with me through YouTube and was grappling with this exact problem. He was 57 and looking to retire imminently. Between him and his wife, they had £500,000 in their pensions, and they were looking to spend £35,000 per year in retirement. £20,000 of that would have covered their core expenditure and enabled them to live a modest life, and the other £15,000 would be discretionary spending that would give them the retirement that they had been looking forward to. Tim had plugged these numbers into my Cashflow Planner, which indicated that he would run out of money at age 85. But the problem is that given that Tim's life expectancy is 84 years old, he almost has a 50-50 chance of running out of money before he dies. But then when you take into consideration his wife, there is a 1 in 3 chance that at least one of them will live well into their 90s. Tim knew that he could just work for longer or spend less in retirement. But because one of his close friends had recently died in their early 60s, before they'd got the chance to actually spend any of their money and enjoy retirement, Tim was desperate to make sure that this didn't happen to him. He wanted to get his time back and live his life while he still can. But all the unknowns of the future had been driving him around in circles, unable to make a decision. And like many, Tim had also been watching the value of his pension drop dramatically over the last year, whilst his cost of living has also been going through the roof, which has knackered his nerves and made him realize that he can no longer stomach being a higher risk investor. Ideally, Tim would like a steady stream of income that can cover his core expenditure. And if he has that sorted, he'd be much more comfortable taking risk with his discretionary spending and varying it depending on the performance of his investments. But there is a textbook solution to this problem, a tool that can provide Tim with a guaranteed income for life, no matter how long he lives. And on paper, this could significantly increase his chances of success. You see, it's impossible to know whether any one individual will die in a given year. But when we're dealing with tens or hundreds of thousands of people, it's possible to accurately predict what proportion will die each year. This is known as the law of large numbers and is the basis for all insurance products. Take car insurance as an example. We have no idea which individuals might have an accident in any given year, but across 100,000 people, it's possible to accurately predict which percentage of us will have accidents and estimate those costs. And by spreading that cost across 100,000 people with yearly insurance premiums, we can insure everyone against that risk. In the same way, the law of large numbers enables us to insure against the risk of outliving our money in retirement. If we take 10,000 60-year-old males, we have no idea which individuals might die in a given year, but we can accurately predict what percentage will. According to the most recent mortality tables, between 60 and 61, we should expect 0.7% to die. The next year, 0.8%, the year after, 0.9%, and on up until 100, where we expect to see 33% die each year. Because this data is so reliable, we can build an insurance product around it that can pay all members a guaranteed income for life. This product is known as an annuity, and just like car insurance, it can provide a much better result than if you were going to try and insure against this risk on your own. Let me show you why. Let's say you're 60 years old and you're fed up with the insecurity of the stock market, and instead you want to create a guaranteed income for life, even if you live to 100. You could solve this problem by investing in a portfolio of government bonds, known as a bond ladder. If you had £100,000 to invest in this strategy and the interest rate on government bonds was 4%, you could draw £5,052 every year. In year one, £4,000 of that income would come from the 4% interest you earn on the bonds, and £1,052 would come from drawing down on the principal. Each year, as your principal gets smaller, so does the interest that you earn. So the difference needs to be made up by drawing more and more from your principal until you finally end up depleting the portfolio at 100 years old. If you want a guaranteed income for life, this is how you do it. Well, almost. If inflation is running at 3% per year, in 20 years' time, that £5,000 will only buy you half what it does today. And in 40 years' time, it will be worth just £1,400. So instead, you could invest in inflation-protected government bonds or index linkers in the UK that will increase their payouts in line with inflation. With this strategy, you would start by drawing £3,045 per year, but this would increase in line with inflation until eventually it starts to pay out more than the normal strategy. Of course, if inflation ends up being higher than expected, you'll break even much more quickly. I know that £3,000 per year doesn't sound like much, but this just shows you how valuable a guaranteed inflation-protected income is, which includes things like the state pension and many defined benefit pensions. Either way, if you want to build yourself a guaranteed income for life, this is how you do it. But in reality, building a bond ladder is quite technical, and there's a high chance that you'll die with a fair amount of money left over. An annuity solves this problem. And with interest rates at 4%, an annuity could pay out £6,558 per year. So that's 30% more than you'd get from doing this on your own. But how does this work? Well, an annuity is a product run by an insurance company. You give the insurer a lump sum of cash, and in return, they will pay you a guaranteed income for life. In the UK, you typically use part of your defined contribution pension to buy an annuity. Between Tim and his wife, they have £500,000 in pensions. So they could first take their 25% tax-free cash and then use the rest of their pension to buy an annuity. This income is then taxed at their marginal income tax rates. And of course, you can only do this once you are able to access your pensions at 55. You also have the option of adding protection against inflation or guarantees that pay out a lump sum if you die within a set period. But each of these protections that you add reduces the income that you will receive. Generally, regulated annuities have 100% FSCS protection, meaning that the government will guarantee that income even if the insurer goes bust. To provide that guaranteed income, the insurer will invest in exactly the same type of bonds that you would do if you were trying to do this on your own. So how then are they able to pay out a much higher level of income? Well, given that annuities are made up of tens of thousands of members, insurers can accurately predict what proportion of those will die each year and use the funds from those that die earlier to balance out those that live longer. So in effect, they only need to plan for the average life expectancy of the group rather than all the way up to 100, which enables them to pay out much higher starting sums to everybody. Annuities have been unpopular for a very long time because the rates that they pay are directly linked to interest rates. But over the last year, as rates have been rising, annuity rates have shot up to levels not seen for 15 years. So how could Tim use an annuity to give him more financial stability and enable him to retire with confidence? Tim has core expenditure of £20,000 per year and a desired discretionary spend of £15,000, with this dropping to £10,000 from age 75. In their situation, buying a full lifetime annuity at retirement might not make sense because from 67, their state pensions will kick in and cover the majority of their core costs. But Tim could use a fixed term annuity to cover the period up to that point. You can use the Money Helper site to compare annuity quotes, which can vary dramatically depending on your age, health, and where you live. So if you're interested in seeing what you might be able to get, I've left a link to this down in the description. In Tim's situation, £20,000 per year for 10 years would cost him £161,000. Remember, a big chunk of that £20,000 payment is Tim's own capital being returned to him, but the internal rate of return still equates to 4% per year, which is slightly above the current yield on government bonds of 3.6%. To be more tax efficient, he could buy half the annuity and his wife could buy the other half to make use of both of their income tax allowances. Although we do need to remember that because this is a level annuity, it has no inflation protection. So the value of those £20,000 payments will fall in real real terms over the years. But even so, this would provide Tim with an income floor to cover most of his core expenses and leave him with almost £340,000 left in his pensions to then provide their discretionary income. Because Tim had been nervous about the stock market, he had reduced the risk of their pensions to be invested in 40% stocks and 40% bonds. If Tim then buys an annuity, given the fact that this acts much like a bond, it would make sense for him to sell bonds within his pension to pay for it, leaving his overall exposure to the stock market unchanged, but increasing the allocation of the remaining portfolio to 60% stocks and 40% bonds. And as Tim said, if his core expenditure is covered, he would feel more confident taking a higher level of risk with the remaining portfolio. The returns of an annuity are highly unlikely to beat the returns of the stock market. But as we've seen, in comparison with certain bonds, they can be attractive. And if we plug this into the original model, we can see that this would significantly increase his chances of success. As I said to Tim, we can't draw too many conclusions from this model because this is just a simple tool that I have built for my subscribers to visualize their retirement plans. But if you are interested in trying this out for yourself, again, you can find a link to this down in the description. With this strategy, we've used an annuity to provide an income at the start of retirement. But as an alternative, Tim could set aside part of their pension, say £100,000, to be invested with the intention of buying an annuity later on in life, at say 75, to provide them with a guaranteed income for the rest of their lives. The advantages of this are that by 75, it's likely one of them will have a medical condition, which could significantly increase their annuity rate. And given that this part of their pension then won't be needed for 18 years, he can confidently invest that at a higher level of risk to achieve a higher return, leaving Tim to focus on drawing down the rest of their pensions over a finite time frame, which is much easier to manage. If interest rates stay at this level or rise even further, I can see annuities becoming useful for lots of people. But even though they make a lot of sense on paper, they get a lot of hate. You see, the thing that people really struggle with is that if you die early, your funds are then used to subsidize those that live for longer, rather than going to your heirs. In Tim's situation, they had already helped their children get on the property ladder, which means that their sole goal for their pensions is to provide them with an income in retirement. And as far as he's concerned, he already plans to use up all of these assets in the pursuit of that objective. What's more is that because he would have only annuitized part of their pensions, there would still be plenty left over if they did happen to die early. The reason why an annuity works so well for Tim is that it reduces the uncertainty of the future, giving him one less thing to worry about. But for that, he has to sacrifice flexibility. Once that annuity is set up, that's it. He can't change it. But for some people, they hate the idea of this. What if annuity rates rise in the future? What if inflation falls? What if my expenditure changes? There is a chance that you will regret this decision. And this regret aversion pushes us away from annuities and towards options where we can change our minds. Like Flexi Access Drawdown, where you can invest your pension how you want and draw income as you please. The only irony is that this flexibility can leave you with so many options and choices and decisions to make that you become paralyzed, unable to decide what to do. So although an annuity is restrictive, it also removes these choices so that you can crack on and enjoy your life. The best solution is likely to be a combination of the two, providing a base level of guaranteed income whilst giving you flexibility over the rest. But I'm interested to hear what you think. Do you think that you'd ever consider buying an annuity? And if so, when? Please do let me know down in the comments. Now, whether you plan on buying an annuity or not, the big decision you need to make is when you're going to retire, which is why you should now watch this video here where I explain why retiring in 2023 may be a big mistake. I'll see you there.